This is a story about a woman we're going to call Maya. She isn't real exactly, but there are tens of millions of her in almost every country on earth, and her story begins somewhere completely ordinary. It's a Tuesday near the end of a long month, and she's standing in the fluorescent hum of a grocery store with a basket of food she can't quite afford this week. Her little boy is asleep against her shoulder. Rent came out a few days ago. Payday is still a week away, and the number at the bottom of the receipt is just slightly more than the number in her account. And then at the checkout on the little screen, she's offered a way out. Split it into 4. Pay a quarter today and the rest over the next 6 weeks. No interest, no credit check that she can see, no judgment. So she taps it the way millions of people are tapping it every single day. And she walks out with her groceries and a strange light feeling like she's just gotten away with something. What Maya doesn't know yet is that she has just taken her first step into the fastest growing, least understood, and quietly most dangerous shift in the way ordinary people borrow money anywhere in the world. The thing you have to understand about the button Maya just pressed is that it is designed down to the last detail to not feel like debt. There's no interest, there's no thick contract, there's no stern person behind a desk asking what she needs the money for. It doesn't feel like borrowing at all. It feels like the shop is doing her a small favor, like a friend quietly covering her until payday. And that feeling, that gentle sense that this somehow isn't really a loan, is not a lucky accident. It is the whole product. That feeling is the thing these companies actually built and sold, and people all over the world have fallen in love with it at a speed that is genuinely hard to picture. Globally, this way of paying is racing past $500 billion a year, on its way toward nearly $1 trillion by the end of the decade. It grew up partly in Australia and partly in Europe, and now it is everywhere under a dozen different brand names in dozens of different countries. In Britain alone, the market went from almost nothing less than a decade ago to more than £13 billion a year, with roughly 1 in 5 adults using it inside a single 12-month stretch. One of the biggest of these companies serves well over 100 million customers across the world. In just a handful of years, this went from a strange little button that a few online shoppers click to a permanent fixture of how the planet buys things, so deeply woven into everyday life that most people, like Maya, no longer even think of it as a financial decision at all. For a while, it works beautifully for her. The first payment is small. The next 3 arrive quietly, and she covers them without much thought. Nothing bad happens. No interest, no penalty, no catch, exactly as promised. And so a few weeks later, when her son needs new shoes because his feet have somehow grown again, she doesn't hesitate. She splits that into 4 as well. Why wouldn't she? The last time was painless. And this is the moment right here where the trap quietly closes its first hinge, not with a disaster, but with a success. Because to understand how Maya gets into trouble, you first have to understand the trick. And the trick is genuinely elegant. Here's the question almost nobody stops to ask at the checkout. If there's no interest, and often no fee, then how do these companies make any money at all? And the answer is that, for the most part, the customer isn't the one paying them. The shop is. Retailers hand these companies a slice of every single sale, and they do it gladly, gratefully, because they have seen what that little button does to their numbers. When you give a person the option to pay in 4, they spend more. They buy the thing they would have talked themselves out of. That pair of shoes stops feeling like the full price and starts feeling like just the first small payment. And the rest is a problem for some future version of you who will surely have it handled. Researchers have watched this happen over and over. The option to split a payment doesn't just change how people pay. It changes how much they buy and how little they pause before buying it. The entire machine is built to dissolve that one tiny moment of friction, the flicker of doubt, where you ask yourself whether you can really afford this, that would normally stop you at the register, and people know it's happening to them. When you ask users directly, around 2 out of every 3 admit these loans make them overspend. Among the youngest of them, it's more than 8 in 10, which is exactly what starts happening to Maya. A new outfit for a family birthday split into 4. A small appliance that finally broke split into 4. A phone bill she couldn't quite cover split into 4. And here is the part that changes everything. She isn't doing all of this in one place. The shoes were through one app. The outfit was through a different one. The appliance had its own service built into the checkout. So now Maya isn't carrying one of these little loans. She's carrying 4, maybe 5, scattered across different apps, each with its own separate due date, its own quiet set of rules, its own little countdown clock ticking away on her phone. And this is enormously common. Around 6 in 10 users are juggling several of these at once, and a quarter of them are carrying 3 or more at the same time. The industry even has a bloodless little word for it. They call it stacking. And the cruelest part of stacking is that there is no single screen anywhere in Maya's life that adds it all up and shows her the honest total number of what she now owes. It is almost perfectly designed to be impossible to keep track of. And slowly, without her ever deciding to, what these loans are for begins to change. In the beginning it was extras, treats, the occasional stretch. But money is tight in a way that never quite eases. And so the button starts creeping toward the things that aren't optional at all. The groceries again, then the electricity bill, then petrol to get to work. This is not just Maya. Across the surveys, the share of users buying something as basic as their weekly groceries this way has roughly doubled in the space of 2 years. People now reach for these plans to cover takeaway dinners, rent, medical bills, a trip to the dentist. And the single most telling number in this entire story is this one: more than half of the people using these services now say plainly that they could not make it through the month without them. Among parents raising young children, the people most like Maya, it climbs even higher. Sit with that for a second. This has quietly stopped being a way to treat yourself to something you want. For millions of people, it has become the bridge that carries them from one payday to the next, which, once you gently peel away the friendly colors and the soft language and the little glowing button, is the exact shape of a payday loan wearing a far nicer outfit. When a person is breaking the cost of food they've already eaten into 4 separate payments, that is not a shopping habit. That is a warning light, and it is blinking in kitchens all over the world. And then one ordinary week, it finally happens to Maya. A shift gets cancelled, or a bill lands early, and one of those 4 due dates slips past her while she's looking at the others, and a fee appears. It's small, just a few units of her currency, almost apologetic. But that same week another app wants its payment, and the money that would have covered it went to the fee. And suddenly she is doing the thing that millions of people in her position spend their nights doing: moving small amounts between apps, robbing one due date to feed another, trying to hold 5 separate little countdowns in her head at once, and never quite able to see the whole picture. Because remember, there is no whole picture. There is nowhere she can look that tells her the truth. This is the moment the weightless thing finally reveals its weight, and she is far from alone. In the country where this habit has been tracked most closely, the share of users who admit they've fallen behind at least once in the past year has climbed and climbed and climbed every single time anyone has measured it, until it reached nearly half of everyone using these loans. Not a bad month. A steady, accelerating trend. And now we come to the part of this that turns Maya's private late night struggle into something much larger and much stranger. And it has a name that sounds like it belongs in a ghost story, because in a way it does. They call it phantom debt. For most of the history of these companies, they simply did not report your loans to the credit bureaus. The organizations that are supposed to keep a record of who owes what stop and really think about what that means. It means that if a bank had looked at Maya's financial history to decide whether she could handle, say, a loan for a reliable car to get to work, every single one of her stacked little debts would have been completely invisible to them. They wouldn't have appeared at all. A person could be quietly drowning under a pile of these plans, sinking a little deeper every month, and on paper, to anyone who actually mattered, they'd look completely fine. The debt was real. The stress at the kitchen table was real. But to the wider financial world, it was a ghost that no one could see. And it's not just individual banks who were blind to it. Regulators around the world started to realize that this enormous, growing, invisible pile was hiding the true level of debt sitting on ordinary households, quietly distorting the whole picture of how much trouble people were actually in. Nobody could see it, not the lenders, not the governments, and lost in a maze of separate apps, arguably not even the borrowers themselves. And the way that invisibility has finally started to lift might be the cruelest twist of all. Here is what Maya believes, and what most people in her position believe, that faithfully paying these loans off on time, month after responsible month, is quietly building up her credit, the way a well-managed credit card would, making it easier for her to borrow properly one day. And for most of the life of these products, that has simply never been true. All that careful, on-time paying did nothing for her standing, because her good behavior was never being reported to anyone at all. But, and here is where the teeth are, if she ever fell far enough behind that one of these accounts got handed to a debt collector, that could absolutely land on her record and follow her around for years. So the deal for a very long time was brutally lopsided. None of the reward, all of the risk. And only recently, in some countries, has that started to change. And it's changing in a way that mostly closes the trap rather than opening the door. The good behavior still often doesn't count for much, while the missed payments increasingly do. A whole generation of people who never once imagined anyone was keeping score are about to find out that someone was. And underneath all of it sits the fine print, the quiet clauses that only bare their teeth once something has already gone wrong. If Maya ever tries to return something she bought this way, she may find it turns into a genuine ordeal, because now there's a shop and a separate lender pointing fingers at each other over who is supposed to give her money back. If she ever tries to dispute a charge she never agreed to, she may discover she has almost none of the protections a normal card would have handed her automatically. And that cheerful promise of zero interest belongs only to the simple 4 payment version. These same companies also nudge people toward longer plans for bigger purchases, and those can carry interest rates that climb past 30%, high enough to make an ordinary credit card look almost gentle. Something that seems perfectly affordable stretched over a few easy months can quietly end up costing hundreds more if you drift onto the longer plan without reading exactly what you signed. So where in all of this are the people who are supposed to be watching out for Maya? The uncomfortable truth is that for years, almost nowhere, this entire industry grew up in a gap, a blind spot in the rules, precisely because it insisted it wasn't really lending in the way older laws understood lending. And only now, far too late for a lot of people already tangled inside it, are the referees finally jogging onto the field, and they're running in different directions. Britain is bringing these companies under real financial regulation, forcing them, for the first time, to actually check whether someone can afford to repay before handing them the money, and giving customers a proper way to complain and get their money back when something goes wrong. Australia has forced them to hold a genuine credit license like any other lender. Europe has folded them into its consumer credit laws. But in the United States, The largest market of all, the exact opposite happened. The agency, whose entire job was to ruin this, enwrote a rule to do exactly that, and then, when the political weather changed, turned around, tore up its own rule, and walked away. So depending on nothing more than which country Maya happens to live in, that identical little button might soon be watched closely or barely watched at all. And it will not surprise you to learn who tends to be standing right at the sharpest edge of all this. It's the Mayas of the world. The people leaning hardest on these loans lean young. They lean toward parents stretching to cover their children. They lean toward the people the traditional banking world already considers too risky to lend to cheaply. The ones with the thinnest cushion of all, being offered the smoothest, most frictionless, most effortless possible way to spend money they don't quite have. The tool that promises to make life a little more affordable is aimed most precisely at the exact people who can least afford for it to go wrong. And to be fair, because this genuinely deserves fairness, used with real discipline, this can be a perfectly sensible tool. Taking one large, planned, necessary purchase and splitting it into a few interest-free pieces, and then paying every one of them faithfully and on time, can be a smart way to manage the timing of your money. Cheaper than a credit card, far cheaper than a payday loan. Plenty of people use it in exactly that careful way and never hand over a single extra coin. The problem was never the simple arithmetic of one well-managed loan. The problem is everything built up around it, a product tuned to make spending feel like it costs nothing, aimed hardest at the people with the least room for a mistake, stacked into invisible piles the system couldn't see, wrapped in fine print that only appears once you're already in trouble, and left for years with almost nobody watching. The danger was never the tool sitting there on the screen. The danger is what the tool quietly, patiently trains millions of people to do without ever once thinking about it. Because, in the end, that is the real question hiding inside that friendly little button. The one that felt so much like a favor on a hard Tuesday at the end of a long month. Is this a smarter, kinder, more flexible way to afford the things you genuinely need? Or is it simply a beautifully engineered way to avoid noticing, for just a little while longer, that you can't actually afford them at all? For Maya, and for the tens of millions of people the world over who are quietly financing their groceries in 4 easy payments tonight, that has stopped being an interesting question to think about. It has become this month's budget, and the bill, however gently it's offered, however weightless it's made to feel, always eventually comes due.